Lending Era, the podcast where we dive into the world of residential, business and commercial finance, bringing you expert insight, tips and strategies to help you navigate the intricate landscape of lending in Australia. I'm one of your hosts, Jessica, and in today's episode, we have a full room. Not that you can see it if you're listening on Spotify, Google or Apple Podcasts, but let's start it off by welcoming the usual voices that you'll hear with me today, and that is David Thomas and Hope Westbury.
Hey Jess, how you
Jess,
going?
how are
Hi
you?
guys, I'm good. How are you doing?
Yeah, very well.
Anything fun happened so far today?
Well, the fact that we've got an extra guest and I got to bring them to the podcast, that was pretty
Oh,
fun.
I was thinking about Dave having scrambled eggs for breakfast.
I
I thought that was pretty exciting.
I didn't know that.
That's the highlight of my day so far.
Yeah, did they have cheese and everything with them?
No.
No, okay, they were poor man's scrambled eggs, but
Yeah.
it's a good kick-off.
Poor Dave.
So without further ado, for our visual audience, you will see that we have a fourth person here. So joining us here today in the hot seat, bang in the centre, we have one of Canberra's up-and-coming accountants, straight out of RSM in Deakin, the ever-effervescent Claudia Youngman.
That is a very flattering introduction. Thank you so much, Jess.
We didn't even use like an online AI robot to help us with that. We just bang on the
ChatGPT.
Yeah, but it's let's get right into it. How did you start off in the accounting world? Because in the most like non-weird way ever, you do not look like the typical accountant that lives in Canberra.
Yeah, well, I suppose the stereotype is a man with a puffer vest, isn't it? But
We discussed it on the way over.
When you think accountant, you kind of think mid-40s, balding, likes red wine, playing golf.
Flannelette shirt, puffer
Flannelette
jacket.
shirt with a vest over it sometimes, like a vest with a full sleeve.
So,
Yeah.
So Claudia is definitely
No,
not
that.
typical accountant. What do you think of
No.
when you hear accountant?
Not at all.
yeah, well, I also hope the typical accountant has changed
Yes.
into not being behind the desk and is sort of like more involved in your business these days. So that's a good thing, but which I think I am, but who knows?
Yeah, I think
100%.
accounting's moving to being more relatable.
Yeah,
Whether they're a business client or a PAYG client, it becomes how do you relate to the client, and does the client feel that you're understanding of their finances and their taxation and I think that communication piece is where accounting is moving to. So
Because of the beautiful faces like yours, Claudia.
Well, it's no longer that I think people fear having to call their accountant. Like I remember even when I was a kid, the accountant was like the least popular person in the town.
Yeah.
Because they made you pay a bill.
Yeah, a necessary evil.
But now you literally manage people's businesses for them. If they don't want to admit it, they don't have to, but truly you migrate everything to do with their business into a platform that is user-friendly for you, them and us. We have a lot of clients that we work with alongside Claudia and the team at RSM. And my God, is it good to have a good accountant working on the other side of the table.
It makes such a difference to us as brokers and even helping with the client experience because you guys are a really key part in that sometimes.
Oh, well, thank you
So
so
thanks.
much.
No, thank you.
And it really does speed up our job. So nothing worse than you have a chat to a client and then you can't give them any advice because you're waiting for 2 or 3 weeks.
Yep.
Whereas sooner we get the information, sooner we can work on things, sooner it gets done for the client.
Happy days.
Yeah.
Happy days.
And it's a bonus that the RSM office is about 100 metres away from our office. So sometimes Dave, office dad of our Trilogy office, will stand in the window and be on the phone to office dad of RSM, Reese Keebers, and they will wave at each other like 2 6-year-old girls with walkie-talkies. I can see you. Oh, can you see George in the car park? Yes, they can all see you, Dave. It's fine.
Is Reese normally wearing a puffer jacket?
Yeah,
Puffer
usually.
vest?
Puffer vest.
Between the months of February and November, yes.
I think Dave said balding and he was just trying to get a little dig in for poor little Reese there. Okay, well, let's get back on topic here. We're having a bit too much fun for a podcast. So let's chat investment properties while we have you here, Claudia. It's probably the thing that was most asked by our clients when we mentioned that we were having someone from RSM on. Now, people really wanted to talk through probably 5 key things that we'll kind of just go down and chat about. So let's start off with the first of the double Ds, and that is deductions.
Deductions, yeah, something that we all want. I suppose like a general rule of thumb that if you're outlaying money for your investment property, it's generally going to be deductible.
Yeah.
Things like insurance is a good one, land tax, council rates, things that can catch people off guard are like your initial costs, so stamp duty in the ACT, because we have leasehold land, so 99-year lease.
99-year lease. Yep.
We can instantly deduct the stamp duty, but in places like New South Wales, it's added to your cost base, so then deducted later on. And then places like Woolloomooloo Wharf, though, where Russell Crowe was, that is stamp duty is deductible because it's on Sydney Waterways. So you can be savvy and find deductibility and stamp duty in other areas.
Wow.
There you go.
Yeah.
It's about what
There
you
you
know.
go.
And
Go
you know,
Rusty.
Yeah, go you. I wouldn't have known that.
Mate, Russell Crowe knew, Claudia.
I think one of the ones that clients come to us is like repairs and maintenance.
Yeah.
Yeah, because that can be a bit grey, can't it? 'Cause
It is
if
a bit
it's
of a
certain,
grey area.
If it's a certain thing, it's a deductible, but if it's
Yeah.
a certain thing, it might be a capital cost.
Yeah, so if you're changing the investment property structurally, like it's a major overhaul, then it's not going to be deductible at that initial point in time. It will deduct it over a period of time.
Yeah.
But
Yeah.
if the dishwasher
Gotcha.
breaks and you get a new dishwasher,
Yeah.
deductible.
Yeah.
Yeah, cool.
Yeah.
Yeah, I think there's a big misconception that buying and flipping an investment property and then putting a tenant in it is so good for your tax because you can just write everything off straight away.
Yeah.
And we get a lot of clients in that bucket that, as you mentioned, do a bit of a back down to the studs and then they think, oh, I can just have a $200,000 write-off this year.
Yeah, that's right.
You're like, absolutely not at all, but throw the dishwasher in. Yeah, that's a good one.
And we're good to go.
$700 there. That's, whew, you've
Yeah.
made money. Now on to the second of the double Ds.
Depreciation.
Yeah.
So talk to me.
So depreciation. So it's a cost that is deducted over a period of time. So you can't deduct it all at once. So like you were saying, if you're doing your major overhaul of your investment property, then we're going to deduct that over a number of years.
Yeah.
Years.
So if we buy a brand new property
Yeah.
and get a depreciation schedule, we
Yeah.
buy a brand new unit here
Yeah.
in Canberra,
Yeah.
do a depreciation schedule, then the building is deductible and fittings and fixtures.
Yeah, that's right.
Yeah, cool.
That's right.
What if I purchase an older property? What if I buy one that is exactly 41 years old? Then
So-
what would be deductible then?
So your stuff like your oven and your fridge and things like that, like the appliances within the property, they're not deductible. But in terms structurally, as we like to call it, accounting jargon, Div 43, that is deductible.
Yeah, okay. So the actual physical building
Yeah.
is able to be depreciated on
Yeah.
an existing building for a property investor,
Yeah,
but not the stuff inside.
yeah, that's right.
Yeah, okay.
And what about gearing?
Gearing.
Yeah,
I feel like it's a hot topic at the moment.
it is.
Yeah. So as we were having a discussion about like the perfect property, so a perfect rental property or investment property would be, on a cash basis, like your rent is covering all of your costs, but then on a tax basis, when you throw in things like your depreciation, it's negatively geared. So that means that essentially your expenses in your property are greater than the income, and then that loss in the property is used to offset your taxable income.
Yeah.
Yeah.
And a large part of gearing is obviously where we come in, which is interest
Yeah.
costs. So,
Yeah.
so interest costs form part, probably the largest part of the gearing equation, don't they? So,
They do.
Yeah. I get this one all the time, so we'll clarify it. It's the purpose of what you borrowed the money for, isn't
Yes.
it? So if I've got a primary place of residence and I release some equity against that and borrow, and those borrowings are for the new investment property,
Yeah.
then it doesn't matter whether I borrowed them against my home. They're deductible against the investment.
That's right. It's what the income producing activity is. So if it's the investment property, then the interest is deducted against that investment property.
Yeah.
Cool.
And as an accountant, I know that you know how we structure loans at Trilogy because you've seen heaps of our proposals and different things that we do.
And personally have one myself.
That's right, that's
Yeah.
right. So I heard that you got a pretty good broker too.
Yeah, I do. I think his name's Hope.
We see a lot of people come to us that have originated those loans in like the branch network and all the loan facilities are like mushed together. Does that make it really tricky for you to figure out like what's deductible, what goes where?
Yeah.
Yeah.
It's always good having like everything separated and a clear-cut picture of the loan structure, and then that way we can figure out which loan relates to what.
Yeah, okay.
Yeah, because as soon as you get to a stage where you, for argument's sake, have a $100,000 loan and they're saying, oh, yeah, but I've used 70% of that for the investment property and the remaining 30% is my personal borrowings.
Yeah.
What a mess.
Yeah, well,
Yeah.
I think you run the risk of like missing expenses that you could potentially be deducting, and like we don't want that. We want you to be able to claim as much as you possibly can. And so does the ATO, believe it or not. So yeah.
Are you vouching for the ATO?
Yeah, a little bit.
So we've chatted about, getting into the property and what's deductible, along the way and, gearing and interest costs and things like that. I suppose, what most property investors get into property for is the getting out at the end, right? So selling, we sell for a profit, we make a lot of money, it's all capital gains because we've owned the property for more than 12 months.
Yeah.
And then how do we kind of deal with that capital gains tax, or what is capital gains tax? What's the equation for working it out?
So capital gains tax is essentially the tax you pay on the profit that you've made on the property. And I suppose like ways that you can mitigate your capital gains tax is if there's two people who have bought the property and then they've owned it for more than a year, which is also the exchange date, not the settlement date. So that's pretty important to know when you're buying off the plan and stuff like that. But it's a 50% CGT discount there. Ways to sort of offset your capital gains tax. We've had some clients who had an investment property in Queensland, and then you can max out your super contribution. So I don't know if you guys know, but you can contribute up to $27,500 to your super each year. If your super balance is less than $500,000, then all of those past 5 years that you haven't maxed out your super contributions, you can then make a large super contribution in the current tax year, and then you deduct that in your tax return, offset it against your capital gains tax.
How clever.
That's an easy
We
one.
love that.
Because you save money, but you're making money if you believe in the model of super.
Yeah.
Which I think 90% of people do.
Yeah. So the realistic, practicality of that is Hope and I buy a property together.
Mate, that's going to spiral.
Perfect.
That's not going to have any CGT.
We pay $500,000 for it. We sell it for $700,000. We've owned it for more than 12 months.
Yeah.
The CGT that we're looking, the actual gain then becomes halved at $100,000.
Yeah.
50 goes to Hope, 50 comes to me.
Yeah.
And then Hope then goes, okay, well, I'll put my 50 straight into super and I won't pay $1 in capital gains tax.
Yeah.
That's so
That's
good.
so good.
Particularly when you look at the rate of return on a super account, and we're all young here, 30 years, and maybe not for Dave, but for us three ladies, we've all got another 30 years in us, Yeah. Now, Dave's got probably four or five.
Yeah. So, and is super the main thing that people do to mitigate their capital gains tax?
I'd say it's like one of the main things that we see people using, but if you need to get like further into it, I recommend like going and either chatting to an accountant or looking at a financial planner as well.
Yeah, to get some other advice.
Because I feel like when you are doing a sale or any kind of investment things, we see a lot of clients who try to do this themselves.
Yeah.
And I feel like you're almost paying additional tax that's unnecessary if you don't just use a professional.
There's so much information out there, isn't there? Like, you run into Tom, Dick and Harry down at the pub on a Friday and they tell you that everything is deductible and then you go and base your decisions off that. So, it can be hard.
Yeah. Uncles at barbecues is a big one for us.
Yeah. Christmas lunch.
Once you're over 30 barbecues, that's it.
Yeah, I love it in January after like the holiday break. You'll have so many clients, usually investors, that heard something at the Christmas table.
Yeah.
They're like, this must be gold.
Yeah.
Gazza told me this. Gazza's a good bloke. And then we're like taking the call, we're calling you guys, and we're all just like, oh, please, do you want to call them?
It never ceases to amaze me how gullible some people are.
Yeah.
And like if someone in their family has said something, they're like, that definitely has to be true.
Yeah.
Like I'm 100% going to believe that.
And you just don't know what you don't know. Like I remember even all of us in this room, we would have bought our first homes at some point, having a preconceived notion of what it would be like. And then you kind of put on like a balancing ball and you're like, far out, I don't know what I'm doing here. I am so off kilter all of the time. I can imagine it's the same if you're not using a qualified accountant.
Yeah.
Like you're just risking it the whole time.
As we always say, get some advice.
Get some advice.
You don't know what you don't know.
We can't give you advice on accounting and taxation, but Claudia can.
Claudia and the team at RSM.
If you call us, we can't help you, but we can transfer your call. We can walk over. Okay, now we have the self-employed clients as well. We have quite a few of the self-employed clients within our database. And now they are generally blessed with deductions. I know we've spoken about deductions for property. There's a myriad of deductions for a self-employed individual. But let's chat a little bit about the deductions available to those individuals that are in a PAYG-based role.
Yeah. So general deductions are going to be your motor vehicle expenses, your travel, uniform expenses, donations. What else have we got? We had working from home in COVID, which was a huge one. The ATO has actually changed the rate in the 2023 year. So it used to be 52 cents in the dollar. You could claim however many hours you work from home alongside your mobile phone costs and your internet costs. They've changed it this year. They've upped it to 67 cents in the dollar. No longer get your mobile phone and internet costs. That's all meant to be captured within that 67 cents.
Wow, how generous of them.
Yeah. So, but if you do want to, it's hard to work out, but if you do want to claim working from home costs, you've actually got to get the square metre of the room against your total house.
Yeah.
And then you can apply your electricity and your mobile phone and your internet costs with that alongside, the other cost you can deduct. But it's very difficult to work out.
Do you think that's because through COVID a lot of people were taking maybe their tax returns for a ride in the sense of...
Taking a bit of the mickey.
Yeah.
They're trying to make the most of everything.
Well, I suppose the ATO is always going to apply to the current or evolve and adapt to the current situation, right? So obviously they would have been seeing a myriad of returns with heaps of working from home deductions, and now they're trying to capture it all in that 67 cents, the fixed rate method.
They mitigate it pretty quickly.
Yeah, they do.
Yeah.
They do. But in saying that, like I said before, the ATO wants you to claim whatever you can claim. It's when people are claiming more than they need to that, you're going to get into trouble.
Yeah, okay.
Because I would assume that the ATO keeps a lot of statistics on various industries and job titles and things like that, and what you can and can't claim.
Yeah.
So, if you're a mortgage broker, for argument's sake, and you put in, car deductions of $100,000 a year, you'd be an outlier. The ATO is going to have a look at it and go, well, actually, the industry statistic is $5,000 and you are 20 times that amount.
Yeah, and
let's have a chat.
That's a great thing to bring up, because their data matching capabilities these days is so good and is just getting better. So they will actually benchmark your tax return against people within the industry who are earning a similar amount to you. So if you're constantly claiming high deductions, you do run the risk of getting an ATO audit.
Yeah, okay.
So just try and sit within the bell curve.
Yeah.
So find out what's not find out what's normal, but understand what's normal for everyone in your industry. Yeah. Look at all your co-workers, what do they claim? Yeah. And you could be somewhat similar. So,
And I feel like when it comes to tax returns, we all have that friend who just puts in 5,000 Ks because it's the maximum, all of the laundry loads a week. Just try and be reasonable, Yeah. There's no point kind of making things up, because you could find out what your co-workers are doing, but if you're not doing it and it's not a true representation of your position...
Probably shouldn't do it.
You probably shouldn't be doing it. No, off the advice of Dad over there, you just shouldn't be doing it, you know. So, and if you fair and reasonably have been spending more than the bell curve, evidence will justify that, and then there's no problem, is there?
Yeah, that's right. As long as you keep your receipts and records, you're fine.
Just be honest, people.
And
looking at you, Dave.
I am always.
You are. Okay, and the final one we wanted to kind of cover, which is a little bit of a shameless plug for yourself and RSM, but where do you typically see clients go wrong with managing their taxes themselves, and how do you add value?
Well, I suppose what we mentioned before, by talking to people down at the pub, which is fine. Who doesn't love a Friday arvo beer? But there's so much information out there, and then if you don't know, you don't know. Yep. So I suppose making deductions that they think they can claim, but they actually can't, and then just not keeping accurate receipts and records.
Yeah.
Yeah.
And on the flip side, using an accountant, it's almost like someone who manages it for you.
Yeah, well, we want to work with the client to get them the best result, because let's face it, dare I say, cost of living and interest rate rises,
Oh,
and
here we
like
go.
everyone's feeling the pinch. So, we want to maximise your deductions.
Yeah.
So, and what about timeliness? Like sometimes I talk to clients and everyone, does their tax returns late for some reason.
Yeah.
Is it better if you PAYG, just get in early, just get it done? Is that?
Yeah. I mean, if you're not lodging with a tax agent or through an accountant, your returns are due on the 31st of October.
Yeah.
If you're with an accountant, it's the 15th of May usually.
Yeah.
There are some variances within that. But I suppose, like, if you want to get your deductions in and, like, get a refund, like, get it in as soon as you can. If you've got everything there, just call someone up. Or if you want to have a go at doing it yourself, then, like, have a go at doing that, see what you get. If you're not happy with it, seek some advice.
Yeah.
Yeah. Get some advice. That's
Get some
David's
advice.
favourite thing to
That's
say.
That's his tagline. If you listen to every podcast we've ever done.
Get some advice and you don't know what you don't know.
Yeah. Correct.
That's it.
Yeah.
Okay, well, I think that covers it. I think the audience has definitely learnt quite a bit. I know I've learnt something.
Yeah, same.
I've learned a lot more from you, surprisingly, than I have from the guys at the pub, which is who would have thought? The uni degree is definitely
I don't
worth
want
it.
to discredit the guys at the pub, though.
No, they'll all be coming at you when this comes out.
Yeah.
Like, we know a lot, Claudia. Be kind. So for the clients that do want to reach out, where can they find you and engage your services?
So if you know where Trilogy is, like you guys have said, we're just across the business park at Equinox in Deakin. Otherwise, you can find us on the RSM website and, like, drop an inquiry through there. Or you can ring our lovely receptionist, Lee, on 62170300. Yeah. Yeah, almost stuffed that up.
No, that's okay.
These days, just a quick Google.
Yeah.
Yeah.
Google RSM Canberra,
Yeah,
and I'm
or
sure.
LinkedIn, anything like that.
Yeah. And you've definitely got capacity to take on new business, don't
We
you, Claude?
absolutely do. Yeah.
Open for business.
Yeah, that's right.
Yeah.
So if your accountant is saying 3 to 6 months before they can even look at it, just hang up the phone, call RSM, come to our office, we'll walk you over, it's fine, we'll stop at the cafe, get a pastry.
Personal
Yum.
escort straight across.
Yeah, brilliant. Okay, well, thank you, Claudia, very much for joining us today. It's been great to have you.
Thank you
This
so
has
much.
definitely been fun.
Yeah, it's been
Thanks,
good.
Claudia.
Thank you
Beauty.
so much.
No
As
worries.
always, guys, you at home listening or in the car, if you do need to get in touch with RSM or Claudia specifically, we'll pop some links in the show notes to take you straight to their website. But otherwise, give us a call and we can connect you too.
No worries.
Beauty.
Thanks,
Easy done.
Jess.
Thank you. Thanks, Dave.
Thanks.
Thanks, Hope. Thanks, Claudia.
Thank you.
Thanks, Jess. Thanks, everyone.
Cheerio.
Bye.